Hello, good day everyone. We are from Group 11 and we assigned to discuss about the Chapter 11, the gearing the cost of capital and shareholders' wealth. So the objectives. In this chapter, we shall deal with the following: the use of borrowing as part of businesses' long-term financing, the effect of capital gearing on WECC, the value of the business and the shareholders' wealth, the traditional view of this effect, the Modigliani and Miller view, the empirical evidence of the effects of gearing and the Camp M, financial gearing and operating gearing, a conceptual conclusion in gearing trade-off theory, and a pecking order theory. Introduction. At several points in this book so far, we have encountered the fact that most businesses raise part of their long-term financing requirements through borrowing. This is sometimes achieved by the issue of loan notes or debentures, but more usually through a term loan for a bank. This gives lenders contractual rights to receive interest, typically at the predetermined rate and on specific dates. Usually such borrowings have to be repaid or redeemed, so the contractual rights extend to the amount to be repaid and to the date of repayment. Some loan notes are perpetual, that is, they need never be repaid. The central point about deep finance is the present context lies in the fact that neither interest nor repayments are matters of the borrowing business's discretion. Interest on borrowing is an annual change on profit. This must be satisfied before the equity shareholders, who in the typical business provide the larger part of the finance, may participate. So in other words, gearing, also known as leverage or financial leverage, refers of the use of debt or fixed interest securities to finance a company's operation and investment. In business finance, gearing plays a significant role influencing the cost of capital and shareholders' wealth. So, a loan from a bank refers to a financial arrangement in which a bank or a financial institution provides funds to a borrower, usually a business or individual, with the understanding that the borrowed amount will be repaid over time with interest. So, the bank loans play a crucial role in providing businesses and individuals with the necessary funds to achieve their objectives. They offer a structured way to access capital with enabling borrowers to spread their expenses over time. It's essential for borrowers to carefully consider the terms and conditions, including interest rates and repayment obligations, before entering into a loan agreement with a bank. Is debt finance as cheap as it seems? So that debt finance can appear cheaper than other forms of financing due to the lower immediate out-of-pocket costs compared to equity financing. However, it's important to consider several factors when evaluating the actual cost of debt finance. So it is widely believed that the capital market prices securities so that expected returns from equities are higher than those from term loans and loan notes. Historically, this belief has been valid over all but fairly brief periods. It is important to assess the overall financial situation, risk tolerance, and long-term financial goals when considering debt finance. While debt can provide immediate access to capital, it also carries the obligation of repayment with interest. Business should carefully evaluate their abilities to service debt and with the benefits and risks before deciding on the appropriate financing mix. Does the apparent cheapness of the finance really mean that equity holders will benefit from the use of it in the business capital structure? The apparent cheapness of the finance does not necessarily guarantee that equity holders will benefit from its use in the business capital structure. While debt can provide lower immediate costs compared to equity financing, it also introduces certain risks and potential drawbacks that can affect equity holders. So the sample in 11.2, so to see how the assertion would work in the case of Lammer, let us assume that the business raised the £1 million for the second vessel for issuing 10% loan notes, that is borrowing at 10% PA. Let us also assume that there is another business, CPIC, identical in every respect to Lammer, but completely financed by 2 million ordinary shares of £1 each. Franco, a holder of 1% of the equity of Lammer, that is 10,000 shares, would expect a return under 1,800 pounds, since, as we have seen, each one expected to yield £18. Franco could equally well obtain the same expected income by selling the shares for £10,000 pound, borrowing an amount equivalent to 1% of Lammer's borrowing, that is £10,000, as the rate of 10% pay, and using this total of 20,000 to purchase 1% of the ordinary shares in C. So 20,000 shares. The C shares would be expected to yield £14 each, and so £2,800 in total, which after paying interest on the borrowing would leave £1,800 of expected income of business and financial, equal to that of the expected income from Lammer. Franco's situation may be restated and summarized as follows. So investment in pound, then income. So present position 10,000 shares in Lammer. So example is 1% of total shares. So 10,000 and 1,800. Then alternative position. So borrow £10,000. So investment 10,000. Then income is 1,000. So buy 20,000 shares in. So 1% of total shares. So investment 20,000. Then 10,000. Then and the income is 2,800. Then 1,800. Capital Financial Gearing, or CG. CG means financing partly through fixed return finance, in practice usually borrowing rather than preference shares. So borrowing is relatively cheap because low risk to lenders and tax deductible. So low risk to lenders means that the probability of the borrower defaulting on their loan obligation is perceived to be minimal or significantly lower compared to other borrowers. When lenders consider a borrower to be low risk, they believe that the borrower is highly likely to fulfill their repayment obligation on time and in full. So the tax deductible, it refers to an expense or cost that can be subtracted from personal or business taxable income, resulting in a reduction of the amount of income subject to taxation. By deducting eligible expenses, taxpayers can lower their overall tax liability and potentially pay less in taxes. So CG has the potential to increase returns to shareholders, and the CG has the effect of increasing the variability risk of returns to shareholders. So business risk and financial risk. So it is shown that annual dividend per share for Lammer, assuming the second vessel is acquired and that all available profit is paid as dividend for each of the two financing schemes referred to above, all equity and 50% debt finance. For various levels of characterizing profits, borrowing enhances returns on equity over those that could be earned in the equity structure, where annual profits are above £100,000 per vessel. Business risk refers to the potential for adverse events or factors to negatively impact the profitability, operation, or overall performance of a company. It encompasses the uncertainties and challenges the businesses face in achieving their objectives and generating expected returns. And the financial risk refers to the potential for adverse financial outcomes or losses arising from a company's financial structure, decisions, or market conditions. It involves the uncertainty associated with a company's ability to meet its financial obligation, manage debt, generate cash flow, and maintain financial stability. Then the 8 for annual profit per vessel, so 50,000 pound and 100,000 pound, then 150,000 pound, then 200,000 pounds. So all equity is the B, the profit. So the annual profit per vessel times 2, so it's 100,000 pound, then 200,000 pounds, so 300,000 pound, then 400,000 pounds. So return per share, so B, which is B is the profit, then divide by 2 million. So the B is the 100,000 divide 2 million is 0.05 pound. Then 200,000 divide the 2 million, so 0.10 pound. Then 0.15 pound, then 0.20 pound, and so on. So 50% loan finance, so the profit, the annual profit for vessel times 2, so 100,000, then 200,000, and 150 times 2 is 300,000 pound, then 400,000 pounds, so less. So interest, the 1 million pound, then 10%, so 100,000, then 100,000, 100,000, then 100,000. Then the net profit is 100,000 pound. The zero for the net income, so the 100,000 pound, the 200,000 pound, then 300,000 pound. So return per share, so the F is the net profit divided by 1 million. Then 100,000 pound divide 1 million is 0.10 pound, then 0. Then 100,000 divide 1 million, so 0.10. 200,000 divide 1 million, so 0.20 pound. Then 300,000 divide 1 million is, as we can see, the business risk and the financial risk. The financial gearing has the effect of accentuating the fluctuation in the returns to equity holders. The basic fluctuation are related to business risk. Gearing adds the effect of financial risk to this. So the Modigliani and Miller or MMU, so shareholders immediately concerned by the existence of gearing, ignoring taxes or cheap debt finance were slightly offset by increasing cost of equity to WACC remains contains at all levels of gearing no optimal level. Then the managers should not concern themselves with gearing questions, and with tax interest cheap enough to cause WECC to fall despite increasing costs of equity. All debt financing conclusion illogical since interest would increase at high levels of gearing. The Modigliani and Miller view of gearing. So in 1958, Modigliani and Miller or MM published an article, and now almost legendary, questioning the traditional approach to the issue of gearing. MM argued that given rational pricing in the capital markets, it is not possible for business to increase its total market value or lower its WECC merely by doing that. It is in theory open to any of us to do. So borrow money. They asserted that this particular business is expected to generate some level of income. This should be valued without regard to how the business is financed. The MM assumptions. So the MM analysis is based on several assumptions which we shall now consider. So first, shares can be bought and sold without dealing cost. So this is obviously unrealistic. So brokers, commissions, and other costs are involved with trading in shares. It is doubtful, however, whether the weakness of this assumption seriously undermines their proposition. So it might mean that investors would be unable to make a profit by exploiting minor instances of mispricing of shares of geared business relatively to those of ungeared ones. The larger instances of mispricing could be exploited despite the existence of dealing charges. This assumption is the capital markets are efficient. So the evidence seems to show that they are efficient for practical purposes in the weak and semi-strong firms. So this implies that investors would see through the financial packaging and realize that income of a particular risk class is equally available irrespective of how it is warped. So it seems that this assumption is reasonable. Then next is the interest rates are equal between borrowing and lending businesses and individuals. So clearly this is invalid. In particular, this is usually a difference between the rates at which individuals and businesses can borrow. So large businesses in particular can often offer good security, can borrow large amounts, and can exploit borrowing opportunities not open to most individuals. So the importance of this assumption lies in the question of homemade gearing, where the investor borrows on his or her account and buys shares in the ungeared business. Then there are no bankruptcy costs. So this assumption suggests that if a business were to be liquidated, the shareholders would receive, in exchange for their shares, the equivalent of their market value immediately before the liquidation. So this assumption envisages in situation where, as a result of business defaulting on interest and or capital repayment, it is liquidated at the instigation of lenders. This sort of action would obviously be more likely with very highly geared businesses. Then the two businesses identical in income, cash flow, and risk exist, one all equity, the other geared. So this assumption is most unlikely strictly to be true. It seems not, however, to be an important impediment to the validity of MM's proposition. Stiglitz, 1974, showed that it is not necessary for two such businesses actually to exist in order for the proposition to be valid. Other thoughts on the tax advantage of debt financing. So Miller, 1977, showed that the tax benefits of gearing for a particular business will depend on the personal tax positions of both lenders and shareholders. Thus, businesses will tend to attract investors, both lenders and shareholders, who are suited to their capital structures. This is known as the clientele effect, where particular policies attract particular types of investors. If Miller is right about this, so the implication is that businesses should probably try to avoid altering their capital structure because this would lead to investors selling their loan notes or share and investing their company or the money in a business that matches their preferences. So this is because the dealing costs involved with selling and buying securities would have an adverse effect on the wealth of the investors. So more recently, Dempsey 1991 showed in the coastal of the UK tax and financial environment that in theory gearing has relatively small adverse on the wealth of shareholders. So the capital or financial gearing refers to the ratio of company's debt to its equity capital, reflecting the proportion of a company's financing that comes from debt compared to equity. It measures the extent to which a company relies on debt to finance its operation and investment. Capital or financial gearing and operating gearing. So we saw earlier in this chapter that the existence of difference in the capital structure accentuates the effect of variation and operating profits on returns to shareholders. This is because at my significant level of gearing, the interest payment represents a large fixed commitment which must be met irrespective of the level of operating profit. There is also a gearing aspect to business operating activities. This is to say, it is not just capital gearing that causes returns to shareholders to vary. Virtually all operations have costs that are fixed irrespective of the level of sales revenue or fixed costs, and costs that vary with the level of sales revenue or the variable cost. The relative proportion of each of these types of costs in terms of the total cost vary from one business to another, depending on the nature of the activities. This phenomenon is known as operating gearing. A business is said to be highly operationally geared with a large proportion of its total costs are fixed costs. Operating gearing, also known as operating leverage, refers to the degree in which a company's operating income or profits are affected by changes in its sales or revenue. It measures the sensitivity of a company's profitability to change in sales volume or activity levels.
Operating gearing is an important concept in financial analysis and management decision making. It helps assess the degrees of financial leverage inherent in the company's cost structure and provide insights into the potential impact of sales fluctuation on profitability. Other practical issues relating to capital gearing, so agency cost. The fact that shareholders must, in practice, rely on the directors, the shareholders' agent, to manage the business can lead to its managed in a way that may not always be in the best interest of shareholders, where the directors to act in a way that is less than optimal from a shareholder's wealth maximization perspective, the shareholders would bear a cost. Next is signaling. So it has been suggested that borrowing additional amounts can be interpreted by the investing public as signaling the directioners are confident enough of the future cash flow that are expected to be generated by the business investment to be prepared to expose the business to the need to make regular interest payments to lenders. So other practical issues are the collateral effect. It seems likely that the particular shareholders are attracted by or at least satisfied with a particular business level of capital gearing. It is to say that those shareholders are content with the risk return trade-off implied by the business level of capital gearing, where the business to alter the level of the capital gearing by, for example, increasing or reducing the level of debt finance. The new level of capital gearing would not suit many, perhaps most, of the existing shareholders. This shift in gearing levels might cause some of the shareholders to sell their shares and to buy those of another business whose gearing levels were more satisfactory. By the same token, some investors might be inclined to buy the shares, whereas previously they would not have done because they like the new gearing level. This buying and selling of shares would be likely to have unrewarded the original shareholders. In addition to understanding the concept of capital gearing, there are several practices issues that are important to consider when analyzing a company's capital structure and gearing. These issues have significant implication for a business financial health, risk profile, and overall performance. So it is important for companies to carefully analyze these practical issues when determining their capital gearing and capital structure. Finding the right balance between debt and equity financing is crucial to ensure financial stability, flexibility, and the ability to pursue growth opportunities while managing risk effectively. So it's important to note that the findings on gearing are not universally consistent across all studies, and the impact of gearing can vary depending on the specific characteristic of companies, industries, and market conditions. Other factors such as the firm size, growth opportunities, industry dynamics, and management quality can also influence the relationship between gearing and financial outcomes. So moreover, the optimal level of gearing for a company depends on its unique circumstances, risk tolerance, and business strategy. It is crucial for companies to carefully assess their capital structure decisions, considering the ability to generate cash flow, service debt obligation, and manage financial risk effectively. Evidence on gearings are some casual observations, so this before going or to some sophisticated studies relating to gearing. It is well worth noting some important points that are arising from casual observation. So it is a very large proportion of business have some level of capital gearing. This seems to be particularly true among larger businesses. Few raise all of their financial requirements from equity shareholders, assuming that management are pursuing a shareholder's wealth maximization objectives. They are presumably using gearing to promote that objective, rightly or wrongly. Therefore, management seems to believe that gearing lowers WECC. The very high levels on gearing are rarely seen. Management seem not to believe when the value of the business is maximized by very high gearing levels. Some formal evidence, so the question to which the answers are of real interest are does weighted average cost of capital change with gearing as after tax suggested? Does it move to a minimum at some level of gearing of less than 100% and it increases as gearing is further increased? So the publication of the articles in capital structure is followed by a number of studies bearing on the above question. So Modigliani and Miller, 1958, themselves took to the lead with the company using data concerning a number of oil and electrical utility businesses and came to conclusion that weighted average cost of capital is not dependent on the level of gearing, supporting their free tax proposition. Some formal evidence on Weston, 1963, criticized the Modigliani and Miller result on the basis that they had made too many sampling assumptions. Weston himself used it on electrical utility business to show that the Modigliani and Miller after-tax proposition was valid in the weighted average cost of capital seemed to decrease when increasing gearing. Miller and Modigliani, 1966, returned to the scene and again used electrical utilities. They too found evidence to support the after-tax proposition. And Hamada, 1972, found that the cost of equity increases with the level of gearing. Masulis, 1980, found that announcement of a business intention to increase the level of gearing tends to be associated with increases in the price of its equity, and the announcements of intention to reduce gearing tend to have an adverse effect on the equity values. This clearly supports the Modigliani and Miller after-tax proposition. It also implies that if there is an optimal level of gearing, investors tend to believe that businesses are operating to below it. Some formal evidence in D'Angelo and Masolis 1980 found an increase in the value of business, or gearing increases to a certain point and a reduction as more debt is added. This was ascribed to the fact that the tax advantage can become decreasingly valuable with higher gearing since the business may not have sufficient taxable operating profits against which the interest expense. In other words, the tax deductibility of interest become the relevant. Brockley Smith and Watts, 1955, found based on the US data that the tax deductibility of interest is a factor in the level of gearing but not a very significant one. Humayfar, Zelt, and Wincato, 1994, found evidence based on US data and the level of gearing tends to be higher with business exposed to higher corporate tax rates. In other words, the greater the value of the tax shield, the higher the level of debt. They also found the larger businesses tend to be more highly geared than smaller ones, perhaps reflecting the greater case with which larger businesses are able to raise external finance. So formal evidence with Graham and Harvey 2001 found that among the U.S. businesses that they surveyed, the tax benefit of the finance is seen as an important factor in capital gearing decision. This is particularly true among larger businesses where the tax rate is higher. They also found the businesses did not see the potential cost of bankruptcy as being an important issue except for those businesses that were already relatively financially weak. So Custer, 1986, found dramatic differences between industrial sectors as regards level of gearing. The highest average level of gearing was found in steel manufacturer, where depth was 1.665 times the market value of equity. The lowest occurred in pharmaceutical manufacturers, where the depth was only 0.097 times the market value of equity. It's not clear why there should be such differences or why these two industries could occupy the positions indicated. One theory concerns the potential cost of bankruptcy. Some industries are liquidate their assets more easily than can others, with less difference between the value of the assets of the business on ongoing concern basis and on bankruptcy sales basis. The trade-off theory. So it is notable that neither of the above two weak assumptions of Modigliani and Miller significantly affects the position of lower levels of gearing. At higher levels, however, they start to loom large. In the light of this, and taking account of the evidence that we briefly discussed, may we perhaps draw a tentative conclusion. Up to moderate levels of gearing, the tax advantages of borrowing will cause the weighted average cost of capital to decrease as more gearing is introduced as after tax predicted. Beyond moderate levels, bankruptcy risk to equity shareholders and the introduction to real risk to lenders would push up the returns required by each group, making weighted average cost of capital a very high figure at high gearing levels. Overall, the trade-off theory proposed that companies aim to strike a balance between the tax benefits of the financing and costs of risk associated with financial distress. The optimal capital structure will vary depending on factors such as the company's risk profile, industry characteristic, profitability, growth prospect, and market condition. So it is important to note that the trade-off theory is just one of the several theories explaining the capital structure decisions, and the actual capital structure of a company is influenced by a variety of factors and considerations. So here is assumed that there is some logic in the case, and therefore weighted average cost of capital will fall as gearing increases and the level of gearing increases above a moderate level. However, both equity holders and lenders will become increasingly conscious of the risk. As a result, they will seek higher returns in compensation. This will drive weighted average cost of capital steeply up. Thus, there will be an optimum level of gearing. The pecking order theory, proposed by Mears and Malloff in 1984, is an economic theory that describes the preferred hierarchy of financing sources for companies. It suggests that companies have a pecking order of preference when it comes to raising capital, with internal financing or retained earnings being the most preferred, followed by debt financing and equity financing being the least preferred. So, picking order theory, it has been suggested by by Mayers 1994 that business do not follow the trade-off theory, or at least not to the letter. The picking order theory is really concerned with the idea of businesses that are reluctant to make new share issues. There seem to be three reasons for this. So as we saw in Chapter 8, share issues are expensive in terms of issue costs. It is believed that managers are often feel that their businesses' share price understates its true value. Issuing new share at this low value would, in their circumstances, disadvantage existing shareholders to the advantage of those taking up the new shares issued. And arising from the preceding point, the managers fear that the market may view making a share issue as a sign that the directors believe the shares to be overpriced in the stock market. Alternatively, it could be viewed as an act of desperation only to be undertaken when the business has no option. These points are likely to make it difficult to make an issue and may lead to a low issue price. So as a result, according to pecking order theory, business will tend to finance their activities in the following sequence. So retain profit, and a dip is which relatively cheap to raise, particularly if in the form of a term loan from a bank or similar institution, and the equity share issue. So retained profit means that, and it is also known as retained earnings or accumulated earnings, refers to the portion of a company's net profit that is retained or reinvested back in the business rather than distributed to shareholders as dividends. It represents the cumulative amount of profits earned by the company that have been retained and reinvested or for future growth and operations. So it is important that the decision to retain earnings or distribute dividends is influenced by various factors, including the company's financial needs, growth opportunities, capital requirements, tax consideration, and shareholders' expectations. Companies must strike a balance between retaining earnings for future growth and rewarding shareholders with dividends, taking into account their financial objectives and the overall financial health of the business. And the debt debt financing, particularly in the form of a term loan from a bank or similar financial institution, can be relatively cheap to raise compared to other sources of financing. And the last is the equity share issue. So it is also known as equity financing or equity issuance. Refers to the process of raising capital for a company by selling ownership shares or equity to investors in exchange for funds. It is a method through which companies can raise capital to finance their operations, investment, or other financial needs. So evidence of the pecking order theory. So Graham and Harvey 2001 also found that most businesses had a target gearing ratio which is inconsistent with the pecking order theory. And the Frank and Goyal 2003 tested the pecking order theory on the basis of what a broad cross-section of U.S. businesses actually did, rather than what businesses said that they felt. During the period 1980 to 1998, they found that the business behaved exactly in the line with the trade-off theory and not as they would have been predicted to behave behave and the pecking order theory being valid. So Ban and Yang 2004 taking a similar approach to Frank and Goyal but using UK data found clear support of the trade-off theory. And Mayrota, Melkelson and Parts 2005 analyzed the behavior of 98 US businesses and concluded that they appeared to act in a manner that was consistent with the trade-off theory but not with the pecking order theory. Barkley and Smith 2005 found that businesses seem to have target gearing ratios which align with the trade-off theory. They also noted that the US businesses that they analyzed seem to be prepared to deviate from the target for periods of time, appearing to that temporarily following the dictates of the pecking order theory. So Betig, Kaudaker, and Thompson 2006 survey a number of UK businesses and found that half of the business had a target gearing ratio, consistent with the trade-off theory. The other half either did not follow the trade-off theory at all or only partially followed it. Their behavior seemed to be consistent with the pecking order theory.
Likely determinants of capital gearing. So having reviewed the theory and evidence on gearing, we can probably summarize the factors that will influence a business decision capital gearing. These are: first is the rate of tax. In the UK, there are clear tax advantages in paying £1 of interest on borrowing rather than paying £1 of dividend. This will in general encourage debt finance. So in the context of capital gearing, the rate of tax refers to the tax rate applied to the profits or income generated from the use of debt financing in the company's capital structure. The rate of tax in capital gearing becomes relevant because the tax deductibility of interest payment can have an impact to the overall cost of debt financing. A higher tax rate generally applies a greater tax benefit from interest deductions, resulting in a lower effective cost of debt. The second one is the tax capacity. A tax-deductible expense has no value unless there is taxable income against which to set it. Also, businesses with lower profits pay a lower rate of corporation tax. Businesses with low earnings tend to find high gearing less attractive. So tax capacity refers to the ability of a company to fully utilize the tax benefits associated with interest deductions resulting from debt financing. So it is important to note that tax capacity is subject to changes in the tax laws and regulations, as governments may introduce new rules or modify existing ones. Therefore, companies should regularly review and adapt their tax planning strategies to align with the evolving tax environment and optimize their tax capacity. The fluctuating sales revenue and/or high operating gearing. Either of these factors, and particularly a combination of them, can lead to severe fluctuation in the returns paid to ordinary shareholders. This may confront the shareholders with an unacceptable level of risk in relation to the returns. It may also increase the risk of bankruptcy and associated costs of the shareholders. So therefore, the combination of fluctuating sales, revenue, and high operating gearing can pose challenges to a company's financial performance and risk profile. It requires proactive financial planning, risk management, and a focus on maintaining financial stability and flexibility to withstand periods of volatility and ensure long-term sustainability. The nature of the business's assets. So in businesses with assets whose value is much greater on a going concern than on a bankruptcy sales basis, that is, those with potentially high bankruptcy costs are likely to avoid high levels of gearing. So it refers to the composition and characteristic of the assets that are used to generate revenue and support the operations of the company. The nature of the assets can have implication for the company's capital structure and the level of the financing it employs. Reluctance to issue new shares. So businesses typically feel that the market undervalues their shares and are not eager to issue new shares at undervalued prices. This is also the fear that the market may perceive a share issue as a last resort, implying that the business is in difficulties. It's important to note that while reluctance to issue new shares may be a valid consideration for many companies, there are situations where share issuance can be beneficial. Issuing new shares can provide a source of capital for growth initiatives, acquisition, debt reduction, or other strategic objectives. Each company's circumstances and financial goals will dictate the appropriate approach to capital raising. Cost of raising the capital. So most equity finance comes from retaining profits. Here issue costs are zero, whereas issues of shares, even rights issues are relatively expensive. The finance tends to be cheap to raise. Inevitably, these facts will affect most decisions on capital gearing. It is important to note that the cost of raising capital can vary depending on several factors, such as the size of the capital raising, the complexity of the transaction, and the type of securities being issued, and also the company's industry and the prevailing market conditions. And the last is the cost of servicing the capital. So the prevailing rates of interest will also be a relevant factor. Servicing the capital refers to the ongoing costs incurred by a company to fulfill its financial obligation related to the capital it has raised. This cost can vary depending on the type of capital, such as debt or equity, and the terms and conditions associated with the capital. It's important for companies to carefully manage and budget for the cost of servicing capital to ensure their financial stability and fulfill their obligations. Failure to meet this obligation can lead to financial difficulties, damage the company's credit worthiness, and strain relationship with lenders or shareholders. Practical issues. So most businesses aim to use gearing but not to very high levels. Also, businesses with high operating gearing may be unsuitable for high capital gearing. Directors may not favor as high a level of gearing is beneficial to shareholders. Agency problem. So businesses may attract shareholders because of their gearing level, the clientele effect. So high tax rates will encourage high gearing, and the tax capacity having sufficient profit to be able to benefit from the tax relief on interest may well affect gearing levels. Also, businesses may be reluctant to make share issues if they believe that they will disadvantage existing shareholders. Then, the relative cost of sharing funds or the issue of cost is the equity from retained profit or the virtually nothing. Equity from rights or public issue are very expensive and the debt finance relatively cheap. Equity from retained profit refers to the portion of a company's equity or ownership that is generated from its accumulated profits, which have been retained within the business rather than distributed to shareholders as dividends. So the second one is the equity from rights or public issue. So it refers to the capital raised by a company by issuing new shares to its existing shareholders or the general public respectively. These methods provide a way for companies to raise additional equity financing to support their operations, expansion plans, or other strategic initiatives. Then the last is the debt finance. So it refers to the practices of raising capital by borrowing funds from external sources such as banks, financial institutions, or bondholders with the obligation to repay the borrowed amount over time, typically with interest. It is a common method used by businesses and individuals to finance various activities, including business operations, investments, and personal expenses. So that's the end of our report. Thank you.